Should you invest in silver now? Can the price really double in 2025? Recently, many people on the internet have started talking about silver, offering their predictions and analyses. But does it really make sense? Well, that's what we'll find out in this video. First, we'll look at the current price of silver and what would need to happen for it to realistically double, and also where this prediction came from. Then, we'll analyze the fundamentals: supply, demand, industrial use, and monetary role. Third, we'll compare it to historical cycles and see what happened the last time silver skyrocketed. And finally, we'll talk strategy, the best ways to get exposure to silver, the risks involved, and how to protect yourself if things don't go as planned. Let's get started. Please don't forget to subscribe and comment to be part of our community. That's it, let's dive in. Well, first part, what's going on with silver now? Let's start with the news that brought silver back into the spotlight. Recently, Robert Kiyosaki, author of Rich Dad, Poor Dad, predicted that silver prices will double in 2025, calling it the hottest investment of the moment. According to him, silver is real money, deeply undervalued, and on the verge of a major breakout due to rising demand and limited supply. Whether you agree with Kiyosaki or not, when someone with his level of reach speaks, the market listens. But what's really happening with silver right now? As of July 30th, 2025, silver is trading at $37.76 per ounce, according to CNBC. That's a significant jump from around $23.25 per ounce just a year ago, a 50% increase in 12 months. Quietly, silver has been one of the best performing major assets of the year. Now here's the math. For Kiyosaki's prediction to come true, silver would need to go from $37.76 to about $75, a 100% gain. That sounds like a stretch, but silver has done it before. In 2010 and early 2011, silver ran from about $18 to $38 in less than a year. So what caused that explosive move? It was a perfect storm of macroeconomic conditions, speculation, and monetary fear. The global economy was still recovering from the 2008 financial crisis, and central banks around the world, especially the U.S. Federal Reserve, were engaging in aggressive money printing through quantitative easing. That triggered widespread concerns about inflation and currency debasement. At the same time, real interest rates were negative, meaning savings were being eroded by inflation, pushing investors toward hard assets like gold and silver. After the 2008 crisis, one of the assets that rose the most was gold, and this significant rise in silver may have been largely driven by people who invested in gold looking for another explosive alternative. Let's face it, they are very similar assets despite their differences. And also, ETFs like SLV, iShares Silver Trust, which had launched just a few years earlier in 2006, made it easier for traders and institutions to gain exposure without buying physical metal. Are we now experiencing a macroeconomic scenario that is also favorable for silver growth? So, are we experiencing a similar setup now? Let's look at some facts. The market expects the Fed to start cutting interest rates soon. Trump is pushing for this. It's not clear if or when it will happen, but there's a good chance it will happen in September. Inflation, while lower than in 2022, is still above target in many countries, keeping monetary fear alive. Industrial demand for silver, especially from solar panels and electric vehicles, is at an all-time high, and supply, it's not keeping up. Silver has posted 3 consecutive annual deficits, according to the Silver Institute. Add to that the renewed retail interest driven by headlines like Kiyosaki's, and you start to see the early signs of another run. Of course, we're not in 2011. The world is different. But the core ingredients, cheap entry, macro tailwinds, and retail curiosity are all starting to reappear. Now that you understand the macro issues, we can do a closer analysis of the asset. Let's move to part 2. Personally, I never invest in something based on hype or just because someone told me I should. Also, I never invest in something I don't see myself holding for a long time. That's why I think it's important to always analyze the fundamentals of an investment and see if they're solid, relevant, and not bullshit. People talk about silver like it's gold's poorer cousin, but the truth is, silver has been been real money for over 6,000 years. Long before paper currencies existed, silver was used in trade, stored in temples, and minted into coins across the ancient world, from Lydia to Rome to China. And even after the world abandoned the silver standard, it never stopped being valuable. Why? Because it still holds three things that almost no other asset does at the same time: monetary value, industrial use, and physical scarcity. But here's something most people don't get. Silver is not like a stock. It doesn't generate cash flow. It doesn't grow like a business. It doesn't become more efficient or launch a new product. It just sits there. So why does it go up? Because value isn't just about production. It's also about scarcity, trust, and utility. Silver gets more valuable not because it produces, but because it's needed and it's limited. You can print more money, you can issue more shares, but you can't print more silver. And once it's used in solar panels, phones, cars, satellites, a lot of it is gone for good. That's what makes it different from gold. Silver is consumed. It disappears from the system, and with industrial demand growing fast, that's a big deal. More than 60% of all silver today goes into industry. It's not just stored in vaults, it's literally powering the modern world. And at the same time, it still acts as a monetary hedge, like gold. That dual identity is what gives silver its explosive potential. But let's be honest here. Although silver has solid fundamentals, and I believe that, like gold, it's a good store of value, these big price spikes are still driven by emotion. Because think about it, if the price rose 50% in less than a year, it's probably not because demand skyrocketed out of nowhere. Like, the industry wouldn't wake up out of nowhere with this giant demand for silver, which means these cycles are more likely driven by emotion. That's the pattern. Post-crisis, people, shaken by inflation and rising rates, are looking for a store of value or searching for a new hot asset that will magically double. I think that's what's happening now too. People are madly searching for an asset that will make them rich overnight. So the tendency is for these high price cycles to have a beginning and an end, and the price to rise gradually over the long term during these periods of significant volatility. And putting that on the table, again, I do think it's a good store of value, but I don't think you should focus on getting in on the dip and then selling at the top of the bull cycle, because it's very difficult to get that right, and you could lose money in the process. I'm not a speculator, I'm an investor. Now, moving to the third part, there's something important. I've said several times that gold and silver are similar, that they go together, but let's understand this in more depth and how you can even benefit from this relationship between the two. Here's how it works. There's something called the gold to silver ratio. It measures how many ounces of silver you need to buy 1 ounce of gold. Right now, that number is 87.65. Historically, that number tends to hover closer to 60, and every time the ratio stretches way above that, it eventually snaps back, either because silver catches up or gold takes a break. What that means is simple. Silver is undervalued right now. If the ratio were to return to its historical average of 60 and gold stayed at its current price, silver would need to rise significantly, possibly above $50 an ounce, just to rebalance that relationship. Because gold usually moves first. Silver follows, but with more force. At least it's how the market has behaved for decades. And apparently, silver hasn't reached its peak price yet. It may not happen, just a cold analysis of the numbers, but it's possible. Gold is the safe haven asset. When fear enters the system, inflation, war, recession, big money flows into gold first. It's more liquid, more stable, and held by central banks, so it reacts faster when macro conditions change. Silver, on the other hand, is more volatile and tied to both monetary and industrial demand. It doesn't react as quickly. But when sentiment shifts from fear to opportunity, or when people start chasing returns, silver becomes more attractive, and that's when it moves. Historically, after gold starts rising, silver tends to lag behind for a while and then explode upward. In 2010, gold was already up 20% before silver really kicked in. But when it did, silver more than doubled in a matter of months. Why? Because silver is a smaller market, less liquidity, more retail action, more speculation. When demand spikes, there's less resistance, so the price can move faster and further. So yes, gold leads, but silver amplifies. Going to the fourth part, let's draw draw some conclusions, and I'll explain a little about how to buy silver and how to invest in this asset. The first and most obvious is buying physical silver, coins, bars, or rounds. If you want something tangible in your hands, immune to counterparty risk, this is the way. But it comes with a spread. You'll pay above the market price to buy, and you'll sell below it. There's also storage to think about, where you'll keep it, how secure it is, and how liquid it'll be when you want to sell. The second option is ETFs, like SLV, iShares Silver Trust. It tracks the price of silver and trades like a stock. It's easier, faster, and more liquid. Great for those who want exposure without the logistics of owning physical metal, but you're trusting the fund structure. It's not silver in your hand. Some investors also look at silver futures, but that's a more advanced strategy. Highly leveraged, short-term, and not recommended unless you really know what you're doing. Bottom line, the way you invest in silver depends on your goal. If you want to preserve value, go physical. If you want convenience, go ETF. But no matter how you do it, timing matters. Right now, silver looks undervalued compared to gold. Demand is strong and supply is tight. The gold to silver ratio is still stretched, and historically, that's when silver has delivered its biggest runs. So if you're going to position yourself, this may be the moment to do it. Not when everyone's talking about silver at $60, but now, while most people still aren't looking. That's how you get in front of the move, not behind it. Buy, cousin, stay invested.